Hello, everyone. My name is Lorene Gilbert, CEO and founder of WealthWise Financial. Thank you so much for joining us this afternoon. We are delighted to have Dr. Quincy Krosby here with us today. Let me tell you a little bit about her. She is LPL's Chief Global Strategist, and previously, Dr. Krosby was the Chief Market Strategist at Prudential and Global Investment Strategist at Deutsche Bank. She also held global market positions at Credit Suisse and Barings. So before coming to Wall Street, Dr. Krosby was a U.S. diplomat. And Quincy, I can't wait to talk to you more about that sometime. Serving in Washington and U.S. embassies abroad, including posting as energy attaché at the U.S. Embassy in London. So she has an amazing.
Oh dear, I'm losing you. Oh my gosh.
Yeah, where she earned her master's and doctoral degrees. So we are so pleased to have you with us here today. And just to let you know, we've got our clients on the line. And everyone knows that last year was a difficult year. Everybody opened their statements from the end of December, and then we're wondering, what does 2023 hold? So we know 2022 was a very difficult year, and we've been talking to our clients about that 2023 is a whole new year. And already we've.
Oh dear, I'm losing you.
Be cut out. I know that they're having some Wi-Fi issues, I believe. But if she doesn't come on, we'll wait a minute, and then if not, maybe we can just move forward and have you start with your presentation.
I can. Oh. Yeah, I can hear. Yeah. So, when we're looking at 2023, I mean, first of all, let me say, it's very, very rare that the stock market has two down years. We did in the unwinding of the tech bubble. And we have to remember what that was. That was with companies that went up, and didn't make any money. If you remember that, I mean, that there was a reason there was that unwinding. And it took 2 years for it to unwind completely. Forgive me, I have a cold. And so that year we saw 2 straight years with the market down. The other one was 2008, 2009. And this is not like 2008, 2009 at all. That was, in essence, like an explosion of leverage, meaning hedge funds that bet 30 to 1, 40 to 1, investment banks, their own money, actually doing the same thing. And it was based on subprime mortgages and the ability to people to pay them. And when everything changed, it had to do with that the unemployment rate started to rise and folks stopped paying their mortgages. And when you have the derivatives, those were based on derivatives, there's always something at the very core of a derivative that's real. It's real. And everything else is derived from that. It's actually very simple. And that was that folks have to pay their mortgages. And it stopped, and it all came tumbling down. It came tumbling down, and it spread to the banks, it spread to portfolios, it spread to the housing market, as everyone knows. The contagion, that's what we call it. The contagion was awful, and that took 2 years. This is different. This is something that is Federal Reserve led. The banks are in much better shape now. And by the way, during this period of easy money, as the markets went up over the last couple of years, all of the companies went out and borrowed money to replenish their balance sheets because money was so easy and cheap. And that's where they are today. And just as we, as consumers, still have money in our accounts, we know that from the bank data that we get, there's still money there. So we continue to spend, and the job market is actually still resilient. And today we even got a GDP number that's about our economy, and it was higher than market expectations. It's a pretty resilient economy landscape. Even the crypto world, if you follow it at all, that had a lot of problems. We didn't see any contagion into the regular market. That tells you about the strength. So what we have going on basically is the Federal Reserve trying to restore price stability. That happens to be the congressional mandate. And price stability is 2%. And so inflation climbing higher, their job is to bring it as close to possible at 2%. And it is the legacy of the Fed. If they don't deliver that, they're going to be leaving us with what we call stagflation, which is much worse. It is no growth and lots of inflation, and they don't want to do that. So it seems horrible, but the worst case scenario is for the Fed to do nothing. Now, this is not a science. I have to be clear about it. It is not a science. I mean, after all, the Fed used the word transitory month after month after month as inflation climbed higher. It got to the point I looked up the definition of transitory. I thought it meant a short period of time. I thought maybe I'm wrong because they keep going on and on about that. But it was inflation climbing higher. And when they finally realized this, that, how do I say this? Realize something we all knew. If you go shopping and you go to the gasoline station and so on, they started to raise interest rates. And they raised it very, very little at first. Then they made it a little bit bigger, and then they made it bigger. And that kept going at that pace, almost 1%, almost, not quite. The good news is inflation is coming down. The good news is that the Fed, most likely next week, is going to give us another rate hike, but very small compared with what they've been doing. And they are going to watch to see how the economy is moving. So that's the good news. The other side of it is earnings. And what we're going through right now is what we call the earnings season. We're looking back. Remember, these are the earnings from just the last part of last year. And what we're paying attention to is guidance. This is what companies tell us. They tell us about what their customers are seeing. They tell us what their clients are seeing. And that's looking ahead. And this is why it is so important. So far, it's been fairly mixed. It's not been great. I have to say that it hasn't been great because the economy is slowing. But the question is, by how much? The question is, are we headed into a recession? And if so, what kind of recession? Believe it or not, there are all kinds of recessions. The recessions can be mild, they can be short, or they could be deep and long and really, really hurt the economy. We don't think we're in that camp at all. We think it is going to be, if there is a recession, it will be short, it won't be as shallow. And a lot depends on the labor market, which, by the way, despite all these layoffs that you're seeing in big tech, despite the layoffs in New York in the financial services, overall, we have a still very strong labor market. So another thing, 70% of our economy is you and me spending. It's consumer spending, 70%. And guess what? We're still spending, albeit we're slowing down a little bit, albeit we're using our credit cards, but we don't see delinquencies on the rise. And so the economy is going to slow. And when you slow an economy, typically inflation comes down. But remember, this has been started by the Fed. They're going to end it. And so in answer, we think of 2023, by the time we end 2023, that the worst is over and we may end the year flat, which flat would be good, but we think we'll actually probably be able to end it a bit higher. So that's the good news. The good news is, to repeat, it looks like the Fed is kind of on their last string of rate hikes, small rate hikes. Then they'll finish. And even if the market sells off, what's interesting about that for all of us is the cost, the valuation, that's how we say it. The cost for this S&P 500 or for individual stocks is going to be compelling. all these companies that are really strong companies are going to be on sale even more than they are now. And that is when we move from what we call a trader's market, with traders going in and out of the market every day, to an investor's market where we go in for the long term. And that's very, very good news. So no, we do not think, absent, some shock to the system, absent that, we think that this year will not be a down year.
Great. And Carissa, can you pull up the presentation and we'll go through a few slides with Quincy.
Of course.
One of the slides, while Chris is putting that up, the one that we're going to look at is stocks typically after the end of Fed rate hike cycles. If you could just speak to that.
This is the one where at the end of the rate hike cycle, stocks go up. Is that what you said?
Yes.
This is interesting
So
because can you hear me, or is it choppy?
I can hear you.
Okay, because on your end it's choppy
Yeah,
for me, and
I
I keep
think
thinking I'm choppy. Okay.
Yeah.
So
No, you're good.
okay. So normally, and when I say normally, historically, when the Federal Reserve raises rates, the market typically goes up after the last rate hike. That's the history of it. My personal, and I say this because we debated at LPL Research, but my view is it's hard for me to imagine in a world in which the market moves so quickly, so forcefully, even before the Fed has raised rates. We've seen it, in the summer. We saw it again in November. Of course, it was staunched by reality. The Fed was not stopping. The bear market was still intact. But it's hard for me to believe that investors, I say investors, not necessarily traders, that they wait for the end to the last rate hike. That maybe, just maybe, because of all of the communication that we get from the Fed, unlike previous years, where they never talked, they didn't have press conferences. So therefore, you really did have to wait until the end to know that it was the end. This time around, as they go through, they kind of tell you what they're doing. My thinking is that just maybe we will see if the bear market is killed, and when the bear market is killed, it'll be around the same time that the Fed is almost finished. We may actually see money coming into the market, investment money that's going to stay for a while, come in before the very last rate hike. And again, it has to do with the communication that you get from the Fed that we never had before. And that's important. And let me also mention one other thing, because this has been something that's fairly new. As of like a couple of weeks, of a change in tone from the Fed. And that has to do with the lagged effects of rate hikes. So everyone always talks about the housing market, right? The housing market, the mortgages go up pretty quickly when the Fed raises rates because it's based on the 10-year Treasury yield. And when the Fed and the market sees that the Fed is getting closer to end or sees growth slowing, the 10-year Treasury yield comes down. Witness the refi movement. When every time that rate comes down, the refinancing goes right up. So here's what I wanted to say. Normally, again, historically, it took about 12 to 18 months for the cumulative effect of rate hikes to flow through the entire economy, every nook and cranny of the economy. That's a long time. Here's what's different. One of the leading members of the Fed board, Christopher Waller, I call him a pragmatic hawk. Hawks are those who say, hey, we got to raise rates. We've got to get back to price stability, come hell or high water. We're not going to feel sorry for the stock market. We're not going to feel sorry for Quincy's portfolio. We've got to do what we've got to do. Even to the point, by the way, of if you've got to kill the labor market, you got to do it because we got to get rid of inflation. Keep in mind when you start and the labor market starts suffering, we stop spending money, and that actually kills off inflation. But here's the change in tone. So Christopher Waller, again, I call him a pragmatic hawk, made this comment. He's also a very well-known economist. He said he's not so sure that it takes 12 to 18 months. He said there's been a major change in communication where everyone knows how what the Fed is doing, what the Fed is thinking. All we do is go out there and talk. So communication is real. People are listening. And he said he thinks, based on his research, that it's not 12 to 18 months for the lagged effect of cumulative rate hikes to show up in the economy. He said, my research is suggesting it's more like 6 to 9 months. Guess what? We're there. It'll be very soon. If he's correct, we will know what happens with the economy. And this is important. So it won't be this long, drawn out thing. And by the way, just so we know, when the Fed starts cutting rates, which they will do at some point, same exact thing. We always thought it took 12 to 18 months to work its way into the economy. If he's right, if Mr. Waller is right, it is going to be a shorter version of it. And this is extremely interesting for us and for the market.
Wonderful. And let's go to the very next slide, which is the title here is Stocks Have Historically Bounced Back After Down Years. And I know
Yes.
you're hitting that earlier, that it's very rare for there to be two back-to-back negative years in the S&P 500. In fact, we've only seen 4 of those. And so if we look at that, Quincy, anything more that you want to say about this chart about bouncing back after down years?
Yeah, well, there's also another element to all of this, and that is that for many years, so this data base is quite thick with years, right? And scenarios in which the Fed was raising rates and the market was down, or the market was down for other reasons. But more and more, what you have is a Fed that comes in with its medicine, right? They come in with their medicine. And therefore, the market, comes bouncing back. We didn't have that earlier. I mean, nobody came in with giving the market money, buying treasury bonds, what we call quantitative easing. That happened ages ago, after World War II, but that's sort of ancient history now. The Fed bought treasury bonds in order to cheapen the debt that was incurred during the war. And then it stopped. No one talked about it until Ben Bernanke in 2008, 2009. So it's made these recoveries quicker. But this particular scenario where we're in now is not a shock to the system. It's not the tech bubble unwinding. It's not, 2008, 2009. It's the Fed inducing a slowdown in order to hinder demand so that they can bring down inflation. That's what they're doing. And they have the levers to stop it. They have the levers if things went off kilt to come in and stop it. At the same time, I want to point out the Fed came in right during the pandemic, just right as it started, introduced its medicine into the market, and the market absorbed it. And we had one of the quickest recessions in history. But they bought an awful lot of treasury bonds in order to push rates down to next to nothing. And they bought mortgage-backed securities. You know what? Get this. They were very worried that the housing market needed help. Oh my goodness. The housing market, as we know, took off like crazy because mortgage rates came down so dramatically. So this is a different scenario. And it's a scenario, again, which is still, as we go through this, where we still have an economy that's growing. We just got the GDP report. It was better than expectations. We have a labor market with, despite all the headlines, on the layoffs. It's still an unemployment rate at this point of 3.5%. And the good news is that what the Fed has been watching, by the way, is wages. And I want to go over that because the last report we saw was helpful for the market to see that things are changing. Why are wages so important for the Fed, a Fed that's fighting inflation? Because when wages go up, wages are an input cost. Wages are an input cost, just like everything else, if I'm a business owner. And you know what I want to do as a business owner? I want to pass along all those costs, including wages, to whoever is buying my services or whatever I'm manufacturing. That's what I want to do. And I raise the prices. And that price hike induces inflation. That's the issue. And the Fed is like, we can't keep this up. We can't keep this up. We've got to get it back into some kind of equilibrium. We can't have wages going up, up, up the way we've been doing it. And so finally, wages are coming down. Also, the last report showed that the work week is getting a little bit shorter. So we could always see those numbers. And why it's that important, it's because the economy is cooling off. We see it in the manufacturing numbers, and we even see it in the larger part of the economy, which is services. Manufacturing in America is down to about 10 to 11%. One thing we are seeing that's very good news is that the prices paid coming down. That is actually in almost every report. Still a bit sticky in consumer services. Sticky by that means it's not coming down as fast enough, but at some point it will start pulling back. Not yet. And then there's the other one that the Fed watches extremely closely, and it's rents. The reason that rents are so important for the Fed in the fight against inflation is that rents are a big portion of people's budgets. And in the consumer price index, it's over 30%. And rents, you know, you've got a contract, you've got a lease, but what we're starting to see is that the rents are coming down, and they will start to show up in the data. Again, showing the market that the rents are coming down and inflation is coming down with it. Is it fast enough? No. I mean, let me put it this way. If the Fed wanted it like overnight, they just have to raise rates dramatically higher than what they're doing now. I mean, they would put us in a deep recession. So getting back to this, it's very rare that you are going to have, 2 years in a row. And again, I go back to previous conversation, and that is, it's hard for me to believe in the market we're in that investors and traders alike are going to wait. Oh, let's wait for the Fed to tell us we're finished. The communication is just too extensive for to wait and see what happens. That happened in 1982 when Paul Volcker finished raising rates in August 1982. The market waited to see, was he finished? And it was difficult. How do you know? They don't talk to anybody. It took economists to figure it out. But now the difficulty is that the Fed talks too much, actually, and sometimes confuses people. So that's why tomorrow morning is going to be an important morning for the market. The Fed's favorite inflation report, the PCE, Personal Consumption Expenditures Index, that's coming out tomorrow morning. We'll see how that looks at inflation. We'll see if it's lower than it was last month. We'll see if it's lower than it was compared with a year ago. It tends to be a cooler inflation look, meaning inflation tends to be less prominent than the consumer price index. That's the other one. And by the way, the consumer price index, the CPI, if you have Social Security, if you've got any kind of government benefit, it's based on the consumer price index, and that is coming down. So all of this has to come in, and earnings are important, but it's something that we always say: the market is not necessarily the economy. The economy is not necessarily the market. Sometimes they cross over, and that's why, I started on a trading floor, and one of the things that I was taught early on is the market gets the news first. Yeah, the market gets the news first. So then when you see the market looking ahead and the economy is slowing, you're wondering, what's going on? How could that be? It's the market sniffing out what it expects over the next 3 to 4 months. And keep that in mind, because it's going to happen. And I believe it's already happening. It's already happening. On the days that the markets are up, we notice that for a number of months now and a number of rallies, that it's the cyclical part of the market that's doing well. That's telling us something. It's telling us that the market is looking ahead for when the Fed finishes and knows what happens typically afterwards. Interesting today, take a look at real estate. That's been coming up, the ETF for real estate. And you'd be like, Quincy, how is that possible? Because it's looking ahead at lower mortgage rates. It's looking ahead at the end of all of this. That's the job of the market. So
look at another slide, Quincy. Let's look towards the end of the presentation at the commodities index versus China GDP growth rate. We know that
yes.
China is reopening and that is a big tailwind looking at emerging markets. So can you make a comment on this, what you're seeing here?
Yeah, absolutely. Because I worked on that. Yeah. So this is fascinating. Okay. Everyone, I think, knows that China had a policy, which is kind of unbelievable, zero COVID policy, meaning whenever anyone in your area came down with COVID, there was a lockdown, literally a lockdown until everyone tested negative. And these lockdowns could last for a very long time. I'll give you one example of Shanghai. And the reason I mentioned Shanghai is that it is a major popular population in China. It is a financial center. It's a manufacturing center. And it also has one of the deepest ports that is in the world. And so it was very important in terms of the global supply chain. They shut it down for 2 months. I mean, and when I say shut it down, I mean it. I mean, you don't go out. And so their economy suffered dramatically. Yet the leadership was wedded to this. They believed it was superior to what we were doing in the West. And they said, you know, this is look at the bodies that build up in the West. We're not going to have that. Finally, they've lifted all of that completely. And so China is still overwhelmed by COVID, but the view is that the herd numbers come in, meaning so many people get it, and then the numbers start coming down. They build up an immunity, herd immunity builds up. And then the goal is to reopen China. That's the goal. We can see it already starting, and here's why. Because China is the world's second largest economy. They are the number one importer of oil. Now, you would say, well, why do they need oil now? It's still kind of weak. This is the irony that we know by the numbers. They're already starting to import oil. The expectations are that the oil consumption is going to increase dramatically as the economy begins to normalize again. So that's one thing. The other is the debate, and this is important, as to whether or not it's going to induce inflation again, because after all, they're going to rebuild. They're going to bring the economy back. But let's be rational about it, because they had built all of the cities that I think they need. You know why? Because half those cities, no one lives there, and they've just built them and built them and built them. In the year 2000, 2001, that is when we saw the greatest super cycle in commodities that we've had. Thank you, China. I used to watch the cement names. It was unbelievable, unbelievable. Iron ore, unbelievable. They were building airports, railroads, cities. It was amazing. Now it looks as though they're focused on something else. One is cleaning up the property market, because that is about 25% of GDP in China. And what is it? Yeah, the property developers built condos all over the country and then just dropped it again, because of COVID. And they have been defaulting on loans. Many of them are dollar denominated loans that came out. China is now focused on cleaning that up and getting them back to finishing up these buildings. And by the way, in China, even if you don't have access to your home, this is what you call your condo, your home, you have to pay the mortgage. And for, we saw quite a bit of Chinese just saying, no, we're not paying. You can't, we're just not paying. We can't get into it. So it's not new construction. It's just finishing up what they have. To be sure, you're going to see a pickup in demand in commodities. They also, though, are focused on something else, and that is personal consumption, just meaning spending. We are already seeing examples of this in many of the focus lists coming out of Western banks. I'm going to give you an example because I think by giving you an example, you'll see what we mean. If you think that the US economy is going to slow and consumer spending is also going to slow, take a look at then Starbucks. And I mentioned it because Starbucks is in China. And the Chinese like to go to Starbucks, although the Chinese leadership would like them to go to the Chinese version of Starbucks. But nonetheless, Starbucks is very popular. As the pattern develops, remember, they're all away on for the Lunar New Year. They tend to go home to where they come from. Many, we could see it from the numbers, are going into Asian countries. But when they come back and things get more normal, they will be going out the same way we did, going out and then just enjoying life again. Same thing going to Europe, the way the Europeans did it, just like we did. And they'll be going to Starbucks. So the analyst, an American analyst, analyzed, and she wrote, I think Starbucks is going to get a boost. Just as the US economy is slowing and maybe spending slows here, they will get a boost from the Chinese going to their Starbucks. So I want to point that out. There are whole lists of what will benefit from China. One other thing, there's an expectation, I just heard it today, we've been talking about it for some time. When the Chinese travel, the Chinese who have a lot of money will go and they will be buying luxury goods. They are going to go to get an underpinning of Chinese money coming in. But there are very long lists: travel, staying at hotels, all of those are named in these buckets of how the Chinese are. So they're focused on personal spending to help the economy, boost the economy, and consumption. The other is and this is where it does get into commodity buying, is electric vehicles. China is determined to be a leader in the EV market. And that does need, it needs lithium, it needs platinum, it needs copper. That will be important. So you're going to see a pickup there. And yet there's one other, and that other is military buildup. China, even during this period of lockdowns, focused on building up their military and military systems. And that requires quite a bit of metals. So there's one other one that I want to point out, which is a little bit different than, iron ore and copper and so on. It is gold. The Chinese central bank has been the whale. That means the big buyer. Who's buying all of this? The Chinese, the People's Bank of China, which is the central bank of China, has been the largest buyer of gold in the market. And people say, why? Why would they be doing it? In many ways, it's probably to diversify away from the US dollar. China was at one point the largest foreign holder and buyer of US treasuries. They have been selling off a bit of that. They had $1.3 trillion of US treasuries at one point. It's down to about $850 billion now. But many analysts who follow the People's Bank of China suggest this, that they saw what happened, the onset of the Russian-Ukraine conflict, and what the US government did and the sanctions the US government put on the Russian central bank. They don't want to be in that position if something were to happen where the relationship deteriorated dramatically. like Taiwan, just to give you an example of something that could trigger that. And so they want to be buyers of gold, and they have been buying an awful lot of it. Other central banks are as well. And the reason there is that, again, this is from the analysts who follow what central banks buy, that there's so much uncertainty in the world, geopolitical uncertainty, and also the deglobalization movement that we're starting to see. How does that unfold? And they are buying gold. And you've seen that in the miners, you've seen that in GLD. So I wanted to put that out. But the notion that the Chinese are going to be buying the way they did as they built cities, as they built airports all over the country, as they expanded their train footprint. No, we don't see that right now. That they've done so much. They're focused on creating an economy that is led by the consumer, and also they want to create a semiconductor industry, which, as you know, is crucial for the electronic vehicle business too. Now and there's a big move in the United States to keep them from getting the chips, because, as you know, the chips can be used for military applications. So that's what we see. We do see a pickup as they come back online into the global economy.
Let's look at the next slide right after where it says policy. The one right after that is stocks have always gained a year after midterms, no matter who's in office. And those are midterm elections from 1950 to current. And no matter who is in office. Can you comment on that?
Absolutely. The uncertainty is over. That's one thing. And even when it's gridlock, which is what we have now, that's considered good. There's a study out, and many studies out, that the market tends to do better when Congress is out of session, when they leave for holiday or something, that the market tends to do better. And the market tends to do better when there's gridlock. It sounds odd, but nobody wants everything to go through. I mean, I will tell you that if you were to look at it party by party, certainly not, and they want a business focus. So with the Democrats, that's not the preferred. If you're going to have power for both, the market much prefers it's Republican and Republican. But that said, the market is quite happy with gridlock. And guess what they've got now? And going to have even more is gridlock. Excuse me.
Yes. A
Right,
lot of gridlock. Absolutely. So now let's go ahead and take the presentation down and just do a little bit of Q&A. I'd love to hear from you what your expectation is on those PCE numbers. We've been seeing numbers coming down on inflation. Do you want to give a little bit of preview of what you think tomorrow?
Yeah, first of all, let me tell you the difference between the Consumer Price Index, the CPI, and the PCE. The PCE, I'll say it again. I'm so proud of the fact that I can say it. The Personal Consumption Expenditures Survey, right, index. It tends to run cooler, meaning lower inflation than the Consumer Price Index. But there's another element to it. And that is, it's more of the information that they get from businesses as opposed to the consumers that you get from the Consumer Price Index. So even in healthcare, it'll be what are they paying towards healthcare for their employees and working with. Are you there? Hi.
We can see you. Yeah.
Okay. Thank you.
We're here.
Okay. And so, can you still see me? Okay. So
Yes.
in any event, the expectations are that in healthcare, we may see it come down. It's been coming down. But again, remember, this is from the business side. This is the information that comes in from businesses as opposed to the consumers. So that may come in, and we expect to see that come down. Travel is also in there, and we're starting to see a little bit of that coming down a little bit. Prices, and why we're in the off season essentially. So ticket prices come down. The question will be about the real estate market. So we want to see that, but we want again, what we want, even if it's at the margin, just a little bit, we want it to be lower than it was. It's important for the market to know that the Fed's medicine is working. Not that it's finished. We do
Well, and
believe
it's important for the Fed too.
yes,
Yeah, it's important for
exactly.
the Fed. We know, and we're leading up, which leads to my next question. We know the Federal Reserve will be announcing in February their next rate increase. Pretty much, we all think it's 25 basis points. Love to hear your comment on that meeting, as well as, do you think they could pause after that, or you think there's one more? And I've heard you say this before. We are closer to the end of the Fed rate than the beginning. So where do you think we
surely.
are? How many more
Surely.
rate hikes?
Well, what we think is, and again, this is all predicated on data, and this is important that we know that the Fed is data dependent, and the market is data dependent as well. We watch the data the same way the Fed does. And remember, the data are lagging. We're always looking back. So when that report comes out tomorrow, it's looking back. It's not forward looking. And by the way, I want to put this in parenthetically. This is why the earnings season is so important, because we are getting guidance about prices, which is what inflation is all about. We're getting guidance about where they see the economy going. And that's what inflation is attached to, because if an economy is going to slow dramatically, typically inflation comes down. So this is why everyone talks about why the guidance from corporate America is so important. I just want to point that out. But in terms of the Fed, so there's something called a futures market. It changes, and it may change tomorrow morning after that report comes out. But that report is interesting. It's the market. It's the market looking at what the Fed is going to do. It says 25 basis points, 1/4% next week, February 1st, and then in the middle of March, the next meeting, another 25. Maybe there could be a pause. Maybe the Fed doesn't, I'm going to go why they don't want to do it. But then it has that the Fed is virtually finished. And how about this? That there are 2 rate cuts at the end of the year. That's important because the Fed has said, no. We're going to stay on hold for the whole year. If we cut rates, it'll be in 2024. Well, guess what? The market is saying, oh, really? We don't really think so. Because the market's saying you're going to slow the economy and you're going to need the rate cuts. That's why. So we'll see what Powell says. This is what's going to be important. What does he say? Because that's the press conference that they have at every single meeting. And the reason it's important is that he has a tendency to swing over to different monetary lanes. Sometimes he's dovish, sometimes he's hawkish. We don't know which Powell is going to come out. And the reason for this is he doesn't want the market to start like getting ahead of itself. And what we call it financial conditions that ease. So if he's too, oh, well, we might just pause. He has said over and over again, we don't want to pause. We don't want to pause because we saw in the 1970s, the then head of the Federal Reserve paused to see what was happening. And guess what? That created tremendous stagflation. And then Paul Volcker had a much harder job to get rid of inflation. And he has said it over and again, we don't want to have a repeat of the 1970s. So therefore, what does he do? I mean, how much lower are you going to go than 25? Can they skip a meeting, which is a pause? We don't know. We'll see if he even addresses it at all. But he may be more hawkish, and he sees the dollar weakening, which is a good thing. It helps multinationals. people are going into emerging markets. Well, why? Because the dollar has weakened. Take a look at when the dollar started to weaken. It was as the Fed started to step down in their rhetoric, letting us know that they were not going to continue with 75 basis points, almost 1%. The dollar weakened against other currencies. That helped emerging markets. That helped to some degree. It helped financial conditions around the world. That's the importance of the US dollar. So we're going to see, but there's a risk management element to the Fed where, again, they don't want it to go where so now they think that we're going to finish. Now the market thinks that it's all over. He doesn't want that because he still doesn't know how the economy is going to unfold. It's not that as though they know more than we know. They don't. They don't. And if you want to ask me how I know, you can do that because I'll tell you. It's really fascinating because we sometimes think, oh, they know so much more than we know. No, they do not.
And we actually have a question from Ken Kerr on the line. He emailed it over. So the question is, what can we expect from the debate over raising the debt ceiling? Will it cause much disruption? How much have the markets reacted when this has occurred in the past?
Yeah, I was afraid. I was kind of looking at my watch and seeing is it the top of the hour, so I could avoid that. Yes, yeah. But yeah, this is everyone asked. So here we go. You know, when Kevin McCarthy finally got the votes he needed on the 15th try, the holdouts, for the most part, were those who said, you've got to promise us that we don't lift the debt ceiling, that we cut the debt to the point that we don't need to do that. And obviously he agreed because he got the votes. The question is that realistic? But one thing that is very important is that they need to cut. It's not just Republicans who say it. There are enough Democrats, you wouldn't think it by listening to the news, but enough Democrats, they've got to cut the fat out. But at the same time, it's very difficult to go in and start cutting Social Security and Medicaid. You know why? Because America is angry. And we hear it all the time. So I do so many client events, but in real life, where then people can speak up. And I hear this all over the country. It's, wait a minute, I paid into Social Security. I paid into Medicaid. This isn't charity. I deserve to be able to count on it and have it be reliable. And then they get even deeper into this. And they said, how dare the people in Congress who will have medical care for the rest of their lives for free. They have pensions that are much better than anything anybody can hope for. And they're telling us what to cut and what they should take away from us. There's tremendous anger there. That said, everyone knows, they know that they've got to sit down realistically. And by the way, just my own sources tell me, these are people I've worked with, tell me that they're meeting. This makes sense. They're meeting. And, they've said, we want to see cuts from both sides. Let's see if we can do this. Now, President Biden said no negotiations. Well, that's great for headlines. It makes them look tough. There are negotiations. And now, though, we thought that June was the date. No, it's now most likely into August. So as we get closer, and if there's nothing, the markets start getting nervous. And I'll tell you what the markets do. You pointed out, the markets, maybe it is different this time. Maybe they will just let us go off the cliff. If that were to happen, all hell breaks loose globally. It's not just about America. All hell breaks loose in markets. And most likely, if that were to happen, the first thing would be that the Fed comes in and buys treasury bonds, that they go in and just buy yet again as much as they can absorb. But I don't think it's going to get there. I don't think that that's what's going to happen. And just one other thing I should point out. In the government, every single agency comes up with options papers. If this happens, then we do this. If this happens, then we do this. So that it's not like you wake up one day and it happened. They've got a series of measures that can be implemented very quickly. But the expectations are that they will come in, they will cut. And again, there are enough Democrats who will agree. I mean, they're not talking about cutting it to the bone, cutting Social Security, cutting Medicaid, but cutting enough to get us through this. In my own experience watching this, I was on the international side of things, but nonetheless, I worked in Washington also, is that they put Band-Aids on everything. They put Band-Aids on everything. They don't go in and redo it to the way that it needs to be done. Nobody wants to be responsible for it. And it gets bigger and bigger and bigger and bigger. I'll give you an example of the cuts. So during the COVID period, my husband was hospitalized. It turned out not to be COVID. It was deep, deep pneumonia that became, what they used to call blood poisoning, sepsis. And I would get the insurance papers. And I would ask him, he was in the hospital for nearly a month. I said, did this guy see you? Did this one see you? No. He'd say no. I'm saying, well, what is this? Well, everybody has examples of this, of the payments out to, from insurance companies for doctors that don't show up, tests that never happened. And his primary physician was at a teaching hospital. He had to go to a local one because it was getting that dire. And she would be talking to his doctors, making sure they were following the protocol to how to treat him. And she would ask them, who else went to see him? They would be like, no one. And yet it would show up on the insurance forms. This goes on every single day for every American. It's got to stop. And nobody wants to do it. And that's the problem. So I don't want to, I sound like I'm running for office after I hang up. It's really worrisome. Here's the other one. I'm going to leave you with this. If they don't do something to fix this even halfway, I'll tell you how they're going to do it. They're going to raise taxes like crazy to pay for everything. Nobody wants that either. But that's what other solution do you have?
Well, and I completely agree. And we do think that we're heading for higher taxes just because we're going to have to pay for all the money that went out there, trillions and trillions of dollars. So that is definitely an expectation. Well, Dr. Quincy Krosby, thank you so much for joining us. So great to see you, even though it's just by internet right now. But we will see you again in person, hopefully soon. Wonderful to have you. To all of our clients, thank you for joining us. Please contact our office directly and we can answer more of your questions and set up an appointment time to talk one-on-one as well for any additional questions that you have. Remember that we have a monthly webinar series. We'll be sending out just like we did for today's webinar and hope you join us again. Thank you so much. Bye-bye.
Thank you.